Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. Wednesday, February 25, 2026. Screens were green, but the day didn't trade like confidence. This felt like a market trying to believe in a soft landing miracle while still bracing for a collision. The lift came from the usual place: mega-cap tech and AI exposure. And the whole session? Basically a countdown clock to Nvidia. So yeah, it was risk-on in the headline indices. But underneath, cautious, crowded, and very selective. Now look at the S&P 500 heat map, and the story gets clearer. The green wasn't evenly spread, it was concentrated. Big, bright blocks in mega-cap tech and communication services, AI-adjacent names doing the heavy lifting. Under the surface, you still had broad red pockets in industrials, healthcare, and staples, with energy and real estate looking mixed to soft. The index was up, but participation did not feel like a clean, confident, everything works day. That heat map pattern lines up with the rotation. Money flowed back into long-duration growth and into the most liquid AI proxies. Technology and communication services did the work. Consumer discretionary helped too, mainly because the megacaps were in the mix. Meanwhile, industrials, healthcare, and staples lagged, and small caps, nowhere near the center of gravity. It didn't look like broad risk appetite expanding. It looked like a tactical retreat into the most crowded, most index-relevant corners. So the contradiction today was pretty simple. On the surface, it looked like the market was back to buy the dip. Underneath, it traded like it was still bracing, rotating into perceived safety that didn't feel all that confident. And the tension centered on the AI industrial complex. Software helped keep the S&P afloat, while the semiconductor side showed signs of exhaustion, that shadow of sell the news psychology. That's what makes the setup feel fragile. Heading into Nvidia, the tape was basically saying, margin for error is near zero. A few unconfirmed narratives were swirling, shaping the feel of the day. First, the AI momentum layer. AMD ripped on reports of a major Meta AI compute deal. Coverage framed it as massive, that fed the rotation into so-called Nvidia alternatives. Second, in semis more broadly, you heard sell the news talk, more vibe than verified fact, with everyone leaning into a binary Nvidia event. And on the macro side, there was still a hangover from earlier tariff escalation fear. The tone improved when the rhetoric cooled, but the bond market read yields churning, not plunging, was taken by some as a sign that inflation risk isn't fully priced out. That's trader interpretation, not a settled conclusion. Nvidia just delivered a $68 billion masterpiece, and the tape refused to take a victory lap. This was the day the AI industrial complex finally got exactly what it wanted and realized the price of admission for the next leg up just went even higher. On the surface, the numbers were a historic beat and raise. Nvidia crushed estimates with $68.1 billion in revenue, up about 73% year over year, and guided to roughly $78 billion next quarter. In a vacuum, that's a moonshot. But look at the price action. The stock's immediate post-market surge toward $203 faded quickly. The tape is whispering that we've hit a perfection priced in phase. When a company adds roughly $11 billion in sequential data center revenue and the market barely reacts, it says conviction isn't driven by excellence anymore. It's driven by fear of what happens when that excellence finally plateaus. The real tension showed up in the gap between the hardware kings and the software giants. Jensen Huang talked about a new industrial revolution, but Salesforce, the original cloud titan, delivered the cold shower. Even with about a 25% earnings beat, Salesforce traded lower after hours. Investors are in show-me mode on its AI Agentforce platform. The market's rewarding the AI factory builders, Nvidia, and punishing the folks who haven't proven they can sell the finished goods at scale. Underneath the headline moves, it looked like a defensive rotation wrapped in a rally. Trillions in market cap are now tethered to one stock's guidance. You've got an environment where single stock moves are running many times more volatile than the index itself. Conviction showed up in Main Street winners like Cava, but faded fast in software as SaaSpocalypse. Anxieties came back. Today mattered because it proved this. Even a record-breaking fire can't stay hot forever if the fuel, liquidity, and software adoption starts to thin out. From here, the margin for error is basically zero. Nvidia was the market's macro switch today. During the regular session, it stayed bid into the print. After the close, Nvidia beat estimates and guided next quarter revenue above street expectations, keeping AI demand confidence intact. But here's the real point. When the whole index leans on one stock as a permission slip, that's not comfort. That's concentration risk, because the generals can't afford to stumble.
AMD turned into the high beta momentum trade of the day. The catalyst was reporting around a big Meta AI compute and chip agreement, which powered a sharp rally in AMD. It traded as the Nvidia alternative vehicle, fast money, high sensitivity, and a clean read on whether AI spending is broadening beyond one name. Just keep the label straight. That deal framing comes from media coverage, not from any company filing in what we've got here. Microsoft was one of the clearest generals in this rebound. It benefited from the rotation into long-duration megacap growth as traders positioned around Nvidia's earnings gravity. And its strength mattered. It helped keep index sentiment constructive, even while big parts of the market stayed heavy. That's the masking effect in a single ticker. Microsoft Green can make the day look a lot healthier than it really is underneath. Meta mattered today less for social media and more as an AI Capex signal. The inputs point to AI infrastructure enthusiasm, including the narrative around a large AMD compute deal. That kept the AI build-out theme front and center, but it also sat right inside the day's tension. Even with big AI spend messaging in the ecosystem, traders were still talking about hardware exhaustion and sell the news shadows in semis. So Meta became a clean question. Is AI spend really broadening or just getting recycled inside the same crowded trades? Palantir was another tell on risk appetite. It kept trading like a high-beta AI software sentiment proxy. Alongside the megacap leaders, it added to the sense that traders were willing to reach for growth, at least in names tied directly to the AI story. It doesn't fix the breadth problem, but it does spell out what kind of risk on this was: selective, theme-driven, and concentrated. Near term, this is about digestion. Thursday, February 26th, is the first test. Do buyers defend the post-NVDA range and push sympathy flows across semis and AI software, or does the tape treat it as a quick positioning release? Then the macro calendar ramps. ISM manufacturing PMI on Monday, March 2nd, ADP and ISM services on Wednesday, March 4th, initial jobless claims on Thursday, March 5th, and a jobs report cluster on Friday, March 6th. No predictions here, just this reality. With leadership this narrow, any macro surprise can hit the tape harder than people expect. Here's the clean wrap. The index was up, but the internals were the story. This was a generals-led rebound, with capital hiding in the most liquid AI-linked names. That can keep the tape afloat, but it also makes the whole market more sensitive to just a handful of tickers. Next session, don't just watch whether the S&P is green, watch who's green, and whether participation finally broadens or stays trapped in the same crowded barn. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.